Hey coconuts, recently there's been quite a lot of discussion about Chinese stocks, and it is predominantly dominated by the Western media, so we had to jump in to add our spin. We will be dedicating this week and next week's shows for this. What you'll be hearing today will be from our live session a week ago, so next time join our live session, yeah? Where we discuss the big names like Alibaba and Tencent, how their business is getting affected by the new legislation, and discuss will they be able to continue to dominate. Whether you're a single stock investor or an ETF investor or your portfolio has China tech somehow, you should listen. These companies form big parts of these funds, and we will also answer many questions from our China construction, finance sector to understanding how politics play a big part in business in China. I'm sure you'll benefit. Welcome back. Welcome to another Chills with TFC session. In this series, we hope to bring out interesting, relevant people to learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shaped around the thinker. So in our pursuit of the life we love while managing our finances well, our guest for today is a popular stock investing blogger. I think it's a little bit insult to call him a blogger. I would call him an independent analyst and a founder of a fund that claims to have gained 276% returns on capital since inception in 2017. Data on the website, yeah, you can go and check. More importantly, they both are fundamental investors which focuses on the business at the core of understanding a stock. So I'm happy to introduce you to Thomas Chua from steadycompounding.com and Eugene Ng from Vision Capital. Two friends joining us today. So yes, Thomas from Steady Compounding and Eugene from Vision Capital. And we're going to talk about, how should you still invest in Chinese stocks today? I think a lot of things have gone on, a lot of things are happening. So do you guys want to start by introducing yourself?
Yeah, man. So my second time here, happy to be here. I'm Thomas, write at steadycompounding.com full-time. I mainly write about investing topics and a lot of deep dives on businesses in the US and in China.
Thanks a lot, Reggie. My name is Eugene. I basically run Vision Capital, which is my own fund, largely on public equities. So I invest over 80 companies, and it's been about close to 5 years now. Been outperforming the market every year, and hoping that we'll continue to do so as well. I'm an angel and early stage investor as well. So that's run by Vision Capital Ventures, which I invest in about slightly over 40 startups. So something that investing is a space that is true to me. I wrote a book actually called Vision Investing, basically thinking that any individual investor can also beat the market.
Really? Wait. I wanna clarify on that one liner of like every average investor, the retail investor can beat the market. What is the basis of that thought? To share?
Yeah, I mean, I think in investing, right, fundamentally we are looking at it very differently. And it's the way we can basically try to change the way we invest and to shift all the odds of success in our favor. And by dramatically doing it, you can actually achieve it. So I think when I set out to write the book, it was to actually do a one-man quest to kind of actually prove to the world that if I can do it, so can you. So I think that was really the case. So I think the book really highlights a very methodological process of how we find winners, winners that keep winning, and hopefully, continue to beat the market over the very, very long run, as Warren Buffett and Charlie Munger always say.
Okay, another Warren Buffett, Charlie Munger fan. Thomas also a very big
Yeah, you can see on my
Charlie
shelf,
Munger,
right?
Warren Buffett fan. Yes, I can see, on his shelf, on his blog and all that jazz. So okay, we can have a chat another time. Eugene should come on our Chills with TFC session. Ernie, do note, shout out to him. We can continue the production from there. But specifically for today, everybody tune in to try to figure out the Chinese markets, right? Because recently there's been a whole slew of regulation, but it's actually not that recent. It's been a while, right? So all the way from Alibaba with the whole Alipay saga, the Ant Financial saga, or NTT, Tencent, everybody kena, right? So it's like a lot of big tech players have gotten this situation, and also the ad tech reform, right? So I just want to, before we go deep into discussing specifics, I want to see if you guys can share with us your read on all these situations with all these regulations and all that jazz.
Yeah, so when investing in China, right, the government is always part of the ecosystem. So we not only must select like really, really good companies, we also have to take the government into account. And this is where there's a guidance which I like to use, which was issued back in 1980 by Deng Xiaoping. It's a 3-point framework. So there are 3 questions investors need to ask when assessing whether to invest in Chinese companies. Number 1 is whether they help to boost productivity. Number 2 is whether they help to boost China's national strength. And number 3, whether they improve the well-being of the people. And you see a lot of these regulations coming in hard on point number 3. Do they really improve the well-being of the people or not? So when investing during this heavy pullback, I'm a net buyer in certain pockets of the companies. So like when you look at the edutech company, the issue there is a lot of the edutech companies were increasing a lot of the education costs for China. And you see this problem being highlighted by the Communist Party several times since 2018. Like the government keep highlighting that the cost of education is becoming too high. Teachers is not teaching core curriculum during normal school hours. They want to teach it after school hours as tuition in order to make more money. And when they start taking VC money and investors' money, they start chasing after a lot of this very strong marketing to make parents FOMO. And in tier 1 city, like if you want to put your children through the top education, there are a lot of estimates that suggest it costs more than $400,000 for them to graduate all the way until university. So like I was talking to Eugene about this also, like on the edutech industry. A lot of these companies are actually trading below cash on their balance sheet. Meaning, like if you were to liquidate the company today and you sell off everything, you just take the cash, you would still make money as an investor. But to me, this is almost like trying to pick a dollar from the train track. It's super dangerous because I have no idea what the Chinese government will want to do there, but rather I would prefer to pick in pockets whereby it's more aligned with the government intention. So boosting domestic consumption has always been one of the key themes that outlined by the Chinese government. So when it comes to buying e-commerce companies, the ideal spot to pick, right, which I think Eugene has an investment here also, which is like, for example, JD.com. If you look at the shareholder letters, right, they are always talking about how they want to benefit everyone in the ecosystem, their employees, the suppliers, the customers. And during this COVID-19 period, right, you see the government praising JD.com a lot because they really help push through the supply chain. Their logistics system is like the best in China. And the most recent letter, they went ahead and automatically raised the salary of a lot of their employees. I'm not talking about senior management here, it's really the ground employee. And you can see a lot of, if you hang out on WeChat ecosystem, often like me, you see their employees getting a lot of perks. The ground level employees, like they will give them iPhones, if you work at JD.com for more than 5 years, they'll give you a room to yourself, because a lot of the delivery personnel, logistics, they are hired from tier 3, tier 4 into the tier 1 cities. So when you're young, it's okay to share room, but as you grow older, you want to start a family, they will give you a room to yourself. So this is what he said, Richard Liu. So like, you need to have dignity, which is why I'm giving a room. So you want to try and get behind management who is able to do right without the Chinese government having to come in and interfere.
Yeah, I think I broadly agree a lot with what Thomas has said. I think the way to think about this really is, it's a very specific sector specific. I think if you think about edutech, right, I think they've gone in a way that has actually, I would say, changed the way of how kids are now studying. I think they were very specific in terms of the government for that particular sector. I don't think it should be taken in a way to generalize, across all Chinese companies. And I think after a large sell-off, the government has actually come down through a morning with the banks and actually decided to clarify that. So I think that's very, very important to differentiate. And as Thomas has said, right, I think if you look at the Chinese government, they're not trying to clamp down on everything. They're not trying to clamp down on all the largest companies. I think more importantly, they're trying to clamp down where they see that it's not making the society better. So I think that's really where the case. So I think it's not to say that we don't invest in China, but I think more importantly, you need to size the risk correctly, right? You are investing in a country where one single action like this, right, for the edutech, you can totally change it and move it totally public, right? I think that is extremely crucial. So portfolio sizing has to be extremely important. You can't go too big a single position or even on an aggregate position on a country level basis. I think that's extremely key. Investing in the right type of companies as well. I think in edutech itself, it is very interesting because you look at it itself, it's actually a bit of a pseudo public good, right, in education. But because of the way the corporates have done this, and they've actually made it almost become a private good. Now, when it becomes something that becomes too expensive and people start spending too many hours on it, it has larger societal complications around it. And I think that's where the government had to clamp down. Now, if I look back at some of the more specific investments around China, I think you really got to be just thinking from that lens as well, making sure that whatever they're doing, they're not taking too much profits. I think China is coming to it has never been in the new world, right? Where they started to have more monopolies, they're making more profits than ever before. I think the China government themselves are also trying to get their head around it, right? We have to kind of control, but we can't control it all, right? These guys are the ones that are really creating the innovation. If you think about it, your Alibabas, your JD, your Baidu, they have actually leapfrogged China into innovation, even comparable with the US, right? So to totally restrict back all of everything, it would provide a large setback to China. So I don't think the Chinese government is intentionally wanting to do that. They just want to make sure that we want to do what's right and set it out for the long term. So I think that's a very, very you've got to think about it really from that perspective.
Yeah, I think last week in our market updates, we talked a little bit about this whole ed tech thing. With the whole 学区房, I think a lot of people that if you don't understand China, you don't understand that there's actually a label called 学区房, which means houses that are near schools, near good schools. Okay, so if it has gone to such a social level where people actually buy properties, specifically near to the school, and there's a whole ecosystem, macam the whole Holland Village, right, convert into education, like private education space, and then everybody live around like Farrer Road, just to get to Nanyang Primary. Right? So that's the idea, and it's wild, it's crazy, and it's a much bigger social implication. So I think that discussion in the ed tech space is not so much focused on ed tech, but the whole broader education reform, right? But I want to dig deeper a little bit into what Thomas was saying, right? So the government is part of the ecosystem. Could you kind of help us understand a little bit more? What do you mean by the government is also part of the ecosystem?
So the Chinese government has also mentioned this a few times. It is not the richest who have the power. It is not the most popular person who have power. It is always the government who have the power, right? So in China, every company's conversation, right, you must include the government inside. You cannot exclude them. So when you see companies like TT, they were directly ordered by the government to not IPO, and they just went ahead regardless, right? Then that's where they saw their app removed from the app store entirely, right? New users cannot sign up, new drivers, you can't sign up also. So when investing in China, it's important to think from the government viewpoint, and the government is actually pretty transparent about this. Every 5 years, they will come together for 2 days and then have a very intensive meeting, set out their KPI, what they want to achieve for the next 5 years. And they call this the 5-year plan. So when investing in China, it's important to read through this 5-year plan. And one of the key things they outlined in the latest 5-year plan was rising costs of starting a family due to aging population. It's becoming quite a serious problem in China. So when the cost of starting family, right, they specifically spell out 2 things. One is education, and second is property prices. Like you correctly mentioned just now, in order to get into a good school, people have to stay near these good schools. And so you see a lot of these property prices coming on. So you can see that the Chinese government in the past few days is also regulating hard in the property sector. And these are also investments which I would typically avoid because it's directly against what the government is trying to do, which is trying to promote more people to start a family. And rising family cost is one of the main deterrent they see. So they see this as enemy number 1. And they are going to try and flatten these 2 industries. Not in the sense they want to destroy it, but it's really for the social good. Yeah, it's really to make sure that don't just blindly chase after profits. You have to look after the country as a whole as well.
So I want to clarify what I'm hearing from you is that on top of the whole education reform, you think that based on their 5-year plan, they're also going to come in to regulate on property prices and property.
Yeah, I think they have already started in some of the provinces. They have already started to clamp down on several of the I think Hangzhou might be one of them, and a few others. So I think that's really where they are going to be next. It's not just limited to property developer in China. I think a few of our Singapore developers have quite substantial investments there as well. So I will be careful about those.
CapitaLand, is it?
I think CDL also has quite a few investments there. Yeah.
CDL. Okay, so in that sense, you'll be concerned about property developers in China, not specifically just Chinese developments.
Yeah, as long as they have heavy investment in China, a lot of the Hong Kong developers also have very heavy investments in China when it comes to residential property. And that's where I would be slightly more concerned.
But I want to kind of zoom into a little bit of what you said in 1980s, right? Deng Xiaoping came in and said that you must help the country, strengthen the economy, strengthen the society, etc. Some of the major pointers, right? How important is it as an investor to try to understand the political dynamics in China? Okay, because for everybody that don't know, I don't claim that I know, but I do know that Xi is not with the same camp as Deng, right? So Deng and Hu, they are the same camp. And Xi is with Mao, right? So Xi has a very different view of how society should be structured, and you see a lot of the whole rolling back of freedom and more democracy, more capitalistic leanings under his rule, right? So understanding companies are really quite complicated. Now you need to understand, like politics and all that jazz, right? So I wanna dig a little bit into your head about how Xi's outlook is going to be like, and how important is it for investors trying to look at China to understand its politics and its political landscape?
Yeah, so knowing that is definitely important. And when you look at what he has done since he has come to power, he clamped down on corruption, and he really tried to push technological advances in China. And you see one recurring theme constantly being highlighted. And since 2018, you look at the big tech players, they have been echoing this. They are going heavy into industrial technology. So when you look at the past decade, right, China has always been extremely strong in consumer internet, meaning your e-commerce, your WeChat, and all that kind of stuff, consumer-facing product. But they haven't been particularly strong when it comes to coming up with SaaS companies, or their cloud is still pretty nascent. So the government mentioned domestic consumption is good, but things like Alibaba 1111 is not going to make the country better. What's going to make the country really better is coming up with business products, your industrial internet, whereby you make it more accessible for businesses to get loans, to do business, your CRM products. And that's where we really want to see. And so you see in the latest Alibaba letter, which was published, I think just last week, they highlighted their pivot into industrial internet pretty heavily. In 2018, Tencent has already started pivoting into industrial internet, and they have actually released a book last year as well on their strategies in the industrial internet. Yeah, so manufacturing is one of the key things they want to maintain. So they are not going to adopt the direction US has adopted. So US went from manufacturing to very strong financial hub, very strong technology. So they say while those growth are good, they don't see being a financial hub, although it can drive very strong growth, it's not a very high quality growth. For China, national security is number one. So they still want to maintain the most dominant manufacturing hub of the world. And they are looking closely at manufacturing as a percentage of GDP. They really want to try and increase that ratio. But the industrial internet is a bit more than just manufacturing. They are also looking at really improving business productivity, because right now a lot of companies are actually facing talent crunch. You see manpower costs slowly creeping up in China. Things are no longer as cheap as it used to be. So the only way to keep growing while controlling the rising labor costs is really to improve your productivity.
Yeah, I think for China, right, when we're looking at this space, we really got to think about what the Chinese government is trying to do. Ultimately, it has the balance in terms of what innovation is. If you try to clamp down on everything, innovation is not gonna happen. So I think the Chinese government is trying to have that split and trying to make sure that they're trying to glide innovation towards a direction where it's towards the end goal which they want, right? Which they laid out in all their 5-year plans and everything that that Thomas has shared a little bit. So I think if you move along that path, right, you have to be already finding companies that are just along that same glide and moving along that same path. If they tend to be, for example, heavily in a part where in a society where it can cause a lot of harm, then we just need to be cognizant of that, and they might sometimes come in and clamp down, and we just really got to be cognizant of that. But I want to just add one point on this for China, right? If you think about it in terms of technology, I think where China knows they're lagging behind is the semiconductor side of things. So if you really think about it, right, they don't have a TSMC equivalent. China themselves, they've been trying to go up the semiconductor space, and to be honest, they have been lagging, right? They've been trying to invest a lot of technology in it. A lot of this kind of innovation doesn't come overnight. It comes massively and takes a lot of time. And they know they're really, really behind it, right? And TSMC is all the cloud. But it is so. I think it's going to be a very interesting space, because as the world becomes more 5G, we're going to have the next industrial revolution. This is going to be a very, very interesting space. Whoever owns the semiconductors will own the next set of technology.
Really?
Yes, I think it's extremely crucial. I think that's why they're trying to develop that and trying to build their own superiority. So I think the next couple of years will be really interesting. Whether can they actually get that throne and try to build it. If not, your heavy reliance will always be on the US, on your TSMCs and the rest, right? And how long can you keep doing that?
Yes, and TSMC has already publicly put in their investor statement that they will not put major technologies in China, right? So they are a Taiwan company, right? So like it or not, most of their most elite development or production lines are all in Taiwan, and some in the US, not so much in China specifically. So I think during the COVID period, it already highlighted a lot of these things, right? How much money you have is one thing. What can you actually produce is another thing, right? So I think there is a lot of discussion in this whole part of growing production capacity, even from a country level, right? So we do have a lot of questions in the comment section. I want to move into some of them. And Geraldine specifically asked, why is manufacturing so important to China? Right, so I think everybody of us have some thoughts. I want to kind of let you guys expound on why is manufacturing important and how do we look at this thing?
Yeah, so when it comes to manufacturing, especially during this COVID period, you can see US having problem getting mask supplies, or even the oxygen tank supply. And you really see when the economy start to shut down, then you start to see the problem of outsourcing everything overseas to China, because China is the factory of the entire world. And people in renovation business will know this. Last year during March, everything has to be delayed because nothing is coming out from China. And so when, as a country, you are that reliant on another country for this capability, right, then it's really going to threaten your country's security, or in events like this, you're just not able to ramp up sufficient production in time. So it's also the danger of outsourcing and putting all your businesses to just-in-time production.
Yeah, if I can add on this point, I think what Thomas is saying is very, very pertinent. I think when we had moved a couple of years ago, we actually moved into just-in-time. We moved into outsourcing, right, where every country uses their own competitive advantage to try to produce a particular good, and which with that we bring down the costs of the overall goods, right? And we have seen inflation come down because costs of goods have just come off. But what happens, I think, with COVID and especially the geopolitical tensions, is start to realize that we might actually be shifting back, a lot of the manufacturing and production back into in-country where possible, and try to secure more of that, right? We can have more of your food supply in-country, more of the production within the country. And I think China is cognizant of that, because when they have heavy reliance, for example, on the semiconductors and a lot of the parts, are dependent on the US. They can't make it, and it's going to significantly affect them. So if I think about it, manufacturing, China has really moved from, I would say, low-level manufacturing to kind of mid-level, and they're actually moving towards higher level, right? And now you see more of this manufacturing started to move towards the likes of Vietnam and all, right? So they are going to move higher and higher end, and eventually it's about GDP and about productivity, right? The higher end and the more value add goods that you produce, the more economic value that you add to the country. The country becomes prosperous, people become wealthier, they spend more, and the whole cycle goes, right? So I think that's one route to bring economic prosperity. I think the government is fully aware of it, and they're just trying to build that next wave of economic progress.
Yeah, I want to add that China built their own space station. Just saying, right? So the US and Russia don't want to play with China. China was like, okay, never mind. I built my own space station. So China has their own space station, and they're building their own GPS system. They have a whole satellite, and some of the US reports are coming out saying that China is even potentially doing weapons, space weapons to block GPS signals from the US. So all that being said, I think China is a force to grapple with. It's not gonna disappear with all these jazz, but definitely a lot of ongoing discussions. But I think summing up the first phase of the discussion, what I could draw out some of the major points is that China is a centrally planned economy with markets. Okay, it's not a market economy, it's very different. Okay, so it's not market driven, it's centrally planned. The government say I want to do all these things, and then you go and do it. All right, so it's essentially planned economy with markets. So you need to understand this as a fundamental to then choose management that can work with this sector and recognize that they are not out to kill their economy. Okay, they just want to kill some things that to them is an ulcer. Okay, they think it's not good, they will cut. All right, so be cognizant about that lah. Fundamentally, is there any other things that we want to add on this main frame? Because I think there are a lot of discussions in the comment section that is very specific companies, specific sector, and I want to pull some of them out. So any things to add, Thomas and Eugene, on this main frame of discussion?
No, I think I'm good.
Yeah, I'm good too.
Okay, great. So we got a lot of questions in the comment section. Please drop your questions in the comment section. We're gonna pull out the simplest one. Is Tencent a buy or sell now? Everybody wants stock tips on. Okay, but by the way, I just want to put it out here that this is for entertainment, education purposes only. It's not any recommendation. Please look for your licensed professional. Okay, but since someone asked, is Tencent a buy or sell to you guys? I think it's a fair question. Recently, there's also a little bit of the whole Tencent music regulation and all that jazz.
Yeah, so I think maybe we can give a bit of our thoughts on what the regulations mean for Tencent. So there are a few key regulations that the music is one thing, but thankfully the music doesn't contribute as much. It's like a drop in ocean for Tencent. So losing the exclusive rights is not really an issue. But what we need to keep a lookout on is the government asking Tencent to do two things. One is you have to remove your walled garden, and the second thing is you need to get minors gaming in check. So the first one, removing the walled garden. What do I mean by this? So back in the early 2010s, I think Alibaba was the first one to block Tencent off its platform, meaning you can no longer use WeChat Pay on Alibaba's platform. Then subsequently, Tencent blocked Alibaba, meaning like if you're on WeChat, which is the equivalent of WhatsApp, you try and put a Taobao link, it will just disappear. It will not appear at all. So this is what I mean by walled garden. They will just eradicate competition like this. You copy paste, nothing will happen. Yeah. Then subsequently, WeChat blocked out ByteDance, which is our TikTok. So there's one important thing to note that for Tencent, when you're buying Tencent, you're almost like buying a tech ETF in China, because they are investing in so many companies, not just in China, but in US as well. Like they own the key gaming companies in US. And when you are reinforcing them to remove walled garden, right? The one concern I have is, can Tencent still gain the priority in investing in all these companies? So the whole reason why they are able to be the angel investor, or they are able to buy large pieces of a lot of companies, is because they are quite gangster. Meaning, like, if you don't sell your company to me, you don't let me take a large chunk, right? I'm going to get you off WeChat. And WeChat, it is not just a messaging app. It is also an app store. Most applications run on WeChat mini programs. Meaning, like, let's say if I were to go to China, I want to, use Meituan. You can launch it on WeChat. You don't have to install a separate app. I want to, book movie tickets. There's going to be another separate app within WeChat mini program for you to do so. So WeChat mini program is, you can think of it as the Apple Store and Google Play Store together. And you think about them having this amount of power. So back then, a lot of companies will say, like, if I don't take Tencent money, if I don't let them become a major investor, It's one thing that I lose the money. It's second thing that I'm not going to get any traffic because WeChat. If we look at marketing terms, right, they are top of the funnel. That's where all the discovery happens. And if WeChat is no longer able to sustain this wall garden, right, my primary concern would be whether this would be detrimental to their future investing capabilities. The second thing about gaming. So this morning, they started to come out and say gaming is spiritual opium, right? And they want to further limit gaming. But so the concern here mainly comes with minors gaming, people under 18 years old, right? And WeChat has been working very closely with the Chinese government since 2018 on managing this. They have actually, so the first thing they did, right, was they block out minors from playing all the accounts. But the problem is a lot of these minors were staying with their grandparents. And grandparents will just give in to their grandchildren. They will give their accounts, their identification card and all that, and then they'll register an account under their grandparents' name. So this year, Tencent actually launched a Midnight Patrol, this AI application whereby if you will play game, right, your phone camera, your front camera will look at your face. And if they think that you're 18 years old, they're going to just shut off your phone. So between 10 p.m. to 8 a.m., you're not able to play game. Is this a problem to Tencent? So right now, I think the amount of hours minors can play for under 12 is 1 hour a day. And for under 18, it is about 2 to 3 hours a day. So this is the orders by the government. Is that a concern? So you see the market swing down by about 10% today. But when you look at the financial report of Tencent, right, minors under 18 only account for 6% of China's gaming revenue. This is not even taking into account the global gaming revenue because Tencent game is big, not just in China, it's big globally. When you look at games like PUBG and all that, I think they have 3 out of the top 10 games of the world, and they command majority of the gaming revenue collected by the entire world. So I see market as overreacting to this morning's news.
Yeah, for me, for Tencent, I think if you think about it right now, the market cap is probably around 600 billion. Since they're probably trading around, I would say, from a sales perspective, it's probably around just slightly under 8x, 8 times sales. And if you think about it for a company whose net income margins are 35%, right? In the world, there are probably less than 20 companies that have a net income margin of 25%. This speaks to the very high quality of the company itself, right? And it has been a steady growing compounder of, I would say, 20 to 30% per year for the last five plus years or so, right? Even, and I guess the fundamental trick is that if you go back down to Tencent, it comprises of a fair bit of businesses, right? Which is you have your gaming, you have your advertising, and you have your fintech, your payments, right? I think fintech and payments is helping the society become better because it's making e-payments easier. So I think that's fine. Online advertising is probably along the same lines. You might argue different variations, but I think the only tricky business really is the gaming business, as what Thomas has said. To push it this way, right? If everyone were to spend their time gaming, it's going to be very detrimental for the society as a whole. But sometimes I like to think about it as gaming as another one of my mentors, my investors actually shared with me, right? Sometimes that, instead of watching a movie, instead of resting, reading a book, I just want to play a game. It's my leisure time, right? I think that there's no balance that says that no, I don't totally go no gaming, or you go to a lot of gaming, right? Such that that whole country dwells into zero productivity. I think that balance is somewhere in between, and I think that's what they kind of need to find that balance with. And it probably need to use, right? So I think Tencent is ultimately using the cash cow of the gaming business and trying to expand into so many other parallels. And I think because of the operating leverage, they can do that. And I think they've been one of the, I would say, the most active, VCs out there and early stage investors investing in so many companies that I see as well. And I think that's a very attractive space that gives them a lot of optionality to kind of bring them to the Tencent arm and help to spread their wings, right? And it makes things easier for them. So at this stage, it is a very high quality company. There are obviously always concerns, of the video gaming. It's probably, I would say, slightly under 50% of total revenues. But I think if you broadly think about it, it is a very solid, it is a very, very solid business, right? I own it myself, Tencent, and I'm still holding it. I've never sold it. And I mean, would I add at current levels? Maybe, but would I buy a lot of it? No, because I think I have to keep my China exposure as part of my portfolio fairly nuanced in terms of I want to cap it. So I think that's how I think about Tencent, right?
Yeah, 树大招风, by the way, for all of you that are listening, in Mandarin just means that if your tree is very big, right, you can get the win. So as long as your company is huge, right, you tend to be regulated by the government and competitors. They will look at you and all that jazz. But personally, I want to add that when I was living in China, WeChat was the only communication platform, and everything can be done through WeChat. So it's like Instagram plus WhatsApp plus you never leave the app. Okay, you can go out with just WeChat. You can delete all other apps. You will still survive in China, right? So that's how crazy WeChat is beyond just the whole gaming business. And I think this is important because a lot of people underestimate platforms. Platforms can spin out a lot of new businesses as an extension, right? So like what Thomas has said, it's the top of the funnel. But yeah, I don't want to over promote Tencent and, and all that shit. But the fundamentals are strong. I think we can all come to agree. So I think that's our review of Tencent specifically. I think other people also want to know about the other big giant. Okay, so it's like you talk about Tencent, you don't talk about Alibaba. You know, they are like frenemies kind of thing. So what is your take on Alibaba, which dominates the other half of China's tech lah? Essentially, it's like Dong Gong and Xi Gong like that. So yes.
Yeah, I think in Alibaba is very interesting, right? Because I think in the first part when you have a leader who started becoming, I think too big for himself, and I think that became a problem for the Chinese government. I think it's always that case, right? They want to make sure that everyone, I can let you make money, but you gotta be just do it right, and not be too show offy. I think clearly they were finding someone very prominent and to make an example of. I think that is very clear, right? I think everyone also more or less got the idea, and I think they all stood kind of in line, right? If you look at Alibaba, it's over 250,000 employees. It's a very large part of Chinese economy. Every part you think about delivery, goes there, right? And without Alibaba, without the likes of JD or Meituan, the economy would not have survived past COVID. So I think the Chinese government realized the importance of Alibaba, and they've been driving a lot of innovation in China, right? So for them to totally clamp down on Alibaba, I think that's not going to be the case. Are they going to be regulated? I would say yes. The e-commerce business is a space where I think they're going to change a fair bit. But I think the e-commerce business is still going to be very, very profitable. I think China. Some might say China's e-commerce penetration is very high, but I say it can always go higher. Right? I think. I mean, the way I would try to think about it is, I think most e-commerce penetration will probably hit I'd say a range between 60 to 80% between each country in the next 5, 10, 15 years. I think that's where I see the bulk of our buying going to be. So I think there's still a lot of room, and it's going to take many years to continue to grow. Be on the 1P on beyond on 3P side, which Alibaba is extremely focused on. I think there are going to be a lot of monetization of the new businesses which they've been trying to grow. Of course, the payment space is a bit tricky with Alipay, I think, and financial. That was obviously very tricky because the business itself was a wonderful business with a lot of optionality, because it was platform. It was a lot of platform bringing a lot of. It's like an aggregator, right? Literally, because you have one platform serving all the customers, and after that you sell down all the risks. Whether it be insurance, be investments, and you just get a cut. You're literally like a broker. So it was a great platform, but I think obviously they've been trying to curtail the risk associated with it. But I think the Chinese government know, right? It's a distribution problem. You have platforms that can bring the distribution and ultimately create positive economic value. I think that's going to be the case. So I've been holding Baba for more than 4 years. It's still a holding for me. It's not. I have no issues, even though it's gone down along with some of the Chinese stocks. I've totally no issues because I know that they do come down with time. Structurally, do I see it disappearing? I don't think so. But I will still continue to always keep a watchful eyes on things. And I think that's going to be very interesting on this space as well.
I want to dig into your discussion earlier a little bit more about capping your Chinese exposure, because like I think we all can agree that these two companies, specifically Alibaba and Tencent, fundamentally they are huge and strong and cash flow doing very well and all that jazz. But you did say that you want to cap your Chinese exposure to manage your risk, right? So can you kind of expound on that a little bit about how are you envisioning that risk management process?
Yeah, I mean, would I want, for example, any of the Chinese stocks to have a 20% of my portfolio, and when they fall 50%, I get back up 10%? I don't think that's going to be the case for me. So I think the number it varies from individual to individual. For me, I think the number is probably not 20%. It's probably significantly lower. It's a number ultimately that I have to be comfortable with, that I can sleep with, right? Even if they drop 50%, I have no qualms, right? Tencent has fallen more than 50%. Baba is probably midway through. I have no qualms, and I sleep very well. I think that's most important. It's ultimately what's the sleep score? Are you fine with that? The way I think about it is it's a balance. It's a basket. I own only four Chinese stocks: Baba, Tencent, Meituan, and JD. I like to own the larger ones because the larger ones are also the more safer ones, in my opinion. And also the ones that are more critical in terms of the services they're providing. So I'm very selective in terms of the services. I didn't choose education tech for a particular reason as well. And also I think that's why I never got a chance to even go to that space. So I think I'm finding those ones that are structurally addressing a very, very big market. The government is unlikely to totally clamp them down fully because they know they're still going to be around. But yet I'm cognizant of the fact that we just have to be cognizant. So would I want China to be, say, 20% of my exposure? I mean, no, I don't think so. It's probably closer. It's probably under 10%, for example, for my portfolio. And it's something that a risk that it's an exposure that I'm very, very comfortable with.
Yeah. And I want to dig a little bit deeper into this whole small tech, big tech kind of thing, because I think in the broader market amongst the retail guys, there's a lot of discussion about finding growth companies and all that jazz, right? But mostly, right, it's all in the US. So nobody really finding growth companies in China. People talk about all these big tech companies in China as though they are like small companies, like very interesting into the future, but actually they are really giants. But I don't really hear discussion about like small tech in China or like upcoming smaller companies. Like it's not really an ongoing talk. Is there some? Do you guys have some thoughts about that part? Like, is there a reason why people are not looking at it, or is there a reason why specifically you're not looking at some of these smaller companies in China? Unlike how people hunt for growth companies in the US.
There are a few factors. One is the information flow among Chinese companies is not as transparent as what we see in US. But for a lot of these like really big companies like Tencent, Alibaba, Meituan, JD, you get a very transparent view of what they're trying to do. They do earnings call and all that. The management is also very vocal about what they are trying to achieve for the company. And as investor, it's important for us to understand the businesses we are owning. I agree fully with what Eugene said. The sleep score is the most important when it comes to investing, right? Your peace of mind. So that you can hold through volatility. And the conviction level comes from how much you know the company. And when investing in China tech, the competition is way more brutal than in US. It's a lot more difficult to tell which company will emerge victorious at the end of the day. So like if you were to take Meituan Tianping, for example, right? When they first started out in the Groupon space, they first started out in Groupon using the Groupon business model. In Singapore, you look at Grab and Uber and maybe Gojek, we think it's super competitive because they keep burning cash. And in US, there's Grubhub, there's Uber Eats, and one or two more players, 4 players in total. And then they think that the competition is super intense. But in China, whenever a tech company start off with a new innovation, there's about 5,000 other competitors coming after this piece of pie. So the range of outcome is super wide when it comes to investing in China for this smaller tech. But when it comes to the platform businesses, like our Tencent and Alibaba, these are more or less like the super powerhouse. In investing, we say like they have a super wide moat already. So as an investor in these companies, right, it's you feel more safe because their competitive advantages are really, really strong as opposed to the smaller companies.
Yeah, if I can add to that point, I think if you think about it in China, right, which are the Chinese stocks that are really available for us as public investors to invest? Are the ones that are probably listed in the US and they're probably quite sizable already. The ones are probably listed in Hong Kong. And the ones in China are not really that accessible for us as retail investors. And the ones in Hong Kong, are probably still fairly sizable, right? So some of the other mid caps and stuff. But if you think about it, like Thomas said, right? The thing in China, because now we're in this internet economy, is really the winners tend to keep winning and they become bigger. And I think that's a very key trend around it, right? Investing in China is very similar to investing in the US in the sense that it is a very, very large market. You have a population of 1.2 billion. You get something right, you're gonna become a unicorn, really, if you get it right and you execute well, right? And it's similar for the US as well. But I think in China, as Thomas is also saying, it's sometimes you don't know what books they have. As a lot of says that in China you kind of have two accounting books, right? One that you show, your auditors, and one the real one that you keep behind, right? And I think the likes of Luckin Coffee and all this is very real, because sometimes you really don't know, and I think it is very important for us to find out, right? We're not on the ground, unfortunately, and we can do all the research that we want, but sometimes we just don't know, and I think that's the toughest bit. In terms of getting that information flow. So that's why also, but it is very, very exciting. I think in China, because of such big economy and such big growth, there's a lot of opportunity. I think we just need to be very strategic about it. Sizing our positions accordingly, and letting them keep winning and let them run.
Yeah, when I was in China, I went to Luckin Coffee. There was nobody. Just saying. I was like, where's my lunchtime meal? Of course, they predominantly do delivery and all that jazz, right? But there wasn't a lot of delivery people coming in and out. I think more people delivering from a Jianping store next door than Luckin Coffee. Anyway, just saying. So, some of my friends, they also pointed out this thought that by the time shit happens, already, lo. Like when shit happens, you will know. Right? So before it happens, you don't know. And I get the idea as to why a lot of people are looking at big tech in China specifically. Okay, so let's move a little bit away from big tech. I think someone actually put up a question. What are your thoughts on investing in the financial and construction sector A shares? Okay, so this is also an interesting discussion. Any thoughts, guys?
No, I've actually never looked at the construction A shares. So I mainly look at Alibaba and all the other big tech. And if you are looking at the financial shares, right, one big concern over the years in China is that a lot of these financial companies, they are encouraged, similar to the edutech, they are creating FOMO to get parents to sign up their kids for tuition, right? A lot of these financial companies are getting people to borrow money to buy things they don't need. So when you look at the Alipay, right, the poster boy for the regulation, you must be very conscious about the financial company you are getting. So Huapay is a part of Alipay, and the main problem the government have with them is the way they are advertising their product. So when you look at Huapay, if we direct translation into English, it's called spend lah. It's ask you to spend. You see a lot of advertisement that goes something like, if you love your wife, you have to use Huapay to borrow money and buy this piece of diamond. If you don't get her this diamond, are you still a man? So the advertisement goes along lines like this to really drive. I'm not talking about like rich people to borrow money. It's really driving the lower income people to borrow a lot of debt to buy things they don't need. And they are able to do so at a very scary scale, because the thing about Ant Financial is they don't need to keep a minimum capital requirement. When you look at banks in Singapore, right, there's a limit to how much they can lend out. But for Ant Financial, there was no limit because they were outsourcing all this lending risk to other banks. So when investing in China, I generally avoid banks in China because I don't trust their accounting. And you have to really select management that you're able to believe, management that are super transparent. Apart from just accounting, you have to look at things like, do they communicate to shareholders? Do they write their own shareholder letters? And from their capital allocation decisions, meaning like the way they spend their retained earnings, shareholders' money, do they give back capital to you or not? Yeah, so these are the few things you want to look at on top of whether they improve the society as a whole.
I love how everything is about improved society. Yeah, just saying. Like invest in China, right? You must care about their societal progress. Okay, Eugene.
Yeah, I think for me, I don't invest in construction companies because I like the way when I invest in businesses, I think about it. And I'm looking for businesses whose revenue streams are very recurring, very predictable, and are growing massively. And in the construction space, it tends to be very one-off. You're constantly looking for deals. You're constantly trying to find. So you want a construction company to be 10x bigger. They got to find a lot of deals. You got to scale it accordingly, right? Because you're in a physical world. It's not something that is easily scalable, and hence as a business itself, it just rules out, and I don't touch those. In finance companies, if I look at it, right, if I look at the top four bank revenues, they'll be just growing at, I would say, a low double digit kind of per year kind of growth. The way I always think about it, if your revenues are going to be growing at low double digits, and your profits are probably going to grow at low double digits, assuming profit margins are going to stay the same, your stock price is going to grow at about low double digits. And for me, that doesn't meet my minimum CAGR or hurdle of investing, and hence I don't touch these. So I think it's just how it is, because typically stock prices will always follow in the very long run how profits, cash flows, and revenues eventually go. And if the top line just doesn't increase that much, the stock price just doesn't increase as much. So I think if I look at banks, that's just generally how I look at it. And I don't own any banks in my portfolio at all, zero. And that's always been the case how I see it.
Yeah, I think Eugene touched on a very important point there. Like when investing in companies, right, it's important to look for companies that have recurring income or generate very high returns on capital. So similar to Eugene, I don't look at construction company at all, and I don't look at airlines at all, simply because they don't make very high returns on capital. So if you think of yourself as a super long-term investor, right? You want to invest in company that's able to consistently reinvest their earnings at super high clip. And there are several sectors who are notorious to not be able to achieve this. Construction is definitely one of them, super cyclical. And while you're able to make money in the short run, as a long-term investor, you're not going to make that kind of life-changing wealth that as investors you should ideally be looking at.
So if I can add one point on Thomas, right? Because I think you mentioned airlines. For me, I don't invest in airlines because the way I think about it is I'm literally always short an option. Because if I had an airline, if you think about it, it always has to be around, I would say, occupancy rate around north of 80, 90%. Then you can make profit. And they make this standard amount of profit, right? So if you think about it, the upside is literally capped. Like if I'm 80, 90% occupancy rate, I'm going to be I'm going to be return well on my capital. But that's the maximum I can return. But when something like COVID hits or an economic crisis hits, the demand just falls through the roof, and basically it is a free fall. If you think about it, they have unlimited downside, and I don't like businesses that have limited top side and unlimited downside, and that's why I also stay away from airlines.
Yeah, and I think it's very good to point out that for a lot of retail investors, I hear this thing like, oh, SQ won't die, government will not let it die. Yeah, won't die by belly breeze, okay? So it's just yeah, so I don't think it's very smart. And specifically, I want to add for construction. I think the guys have pointed out very clearly that construction is very reliant on deal flow, very high capex, and very reliant on deal flow. So even you look at CapitaLand recently, they've also restructured their business, right? So they're going to privatize their construction business and just focus on the management business, asset light, high CAGR business, right? And they're going to privatize the whole deal construction because nothing to construct. Okay, but anyway, so that's the idea, right? Generally, I think as a retail investor, you want to be in spaces that you understand. So if you are talking about financial or construction, then I hope that you have superior insights when looking at these kind of companies. If not, then generally I will avoid these sectors. Specifically construction, I think it's a very hard space to be in. Everybody is just fighting margins. And if you want to talk about China specific, if you think politics is complicated, right, then China construction politics is going to be even more complicated for you, okay, to try to decide who is going to get the deal, what's going to happen. There's a lot of insider things going on, and that is the reality, okay? So if you guys have any other questions, please drop in the comment section and we'll pull it out. If not, there's one more question here that I think will be pretty interesting because pretty sure most people most of you guys have this in your portfolio. So Meituan's future. I engaged with Meituan in the early days of the Groupon days. Right, so that was about 5 years ago. I was staying in China. So yes, Meituan was amazing. Meituan Dianping was the place where I go and buy all the cheap stuff lah. But I know since then things have changed. So yeah, hear your views about Meituan specifically as a company.
Yeah, maybe I touch on the regulation side. So the problem that's confronting Meituan now is a few things. One is the Chinese government actually want Meituan to provide insurance to all these gig economy workers. So gig economy workers, we are looking at our Grab food riders, Foodpanda, or your Grab drivers. So a lot of these gig economy workers, they don't have social net, and the salary they are currently drawing is extremely low, even by China standards. So the thing about Meituan is this: they are very heavy in. They're one of the leading food delivery platforms in China. And recently, with the shutdown of Didi on the App Store, right, they have also gone back into ride-hailing. And the challenge is really trying to estimate how much this will damage them, because as of now, the Chinese government have not exactly given an idea of how much insurance they need to buy, or what is the minimum amount of which you have to provide for all your riders. But here is how I see this. Even though food delivery accounts to about 70% of Meituan's revenue, it only comes down to 20% bottom line, meaning food delivery itself is a very thin margin business. And Meituan is the first and the only one in the whole world that is profitable in food delivery, right? But I'm all right if they even just break even, because what Meituan do is they are a super app. Not everything on Meituan must be profitable. They are into groceries. They are into booking of movie ticket, booking of massages. They are the Yelp of China, food reviews, So they are really the all-in-one app in China when it comes to, doing your day-to-day stuff. And booking of your massages, your hotels, your airline tickets, these are where the high-margin business is. So when you look at the booking of hotels, all this, the revenue only comes up to about 20 to 30%, but it flows down to 70% bottom line. So that's really where the crown jewel of Meituan is. If you only look at the revenue composition, it might be a bit misleading. But when you look at the bottom line, the amount of net profits after deducting for all the costs, the majority of it actually comes from other things. And it pays well for Meituan to even just break even, because food delivery, groceries, all this, even though they are low margins, they are high frequency, meaning users have to keep accessing Meituan at several times a day. And in marketing terms, right, we call that very high engagement rate services. Not profitable, but high engagement rate. And because they are so high engagement, right, the users are more likely to use them to book hotels, to book airline tickets and stuff like that. So I'm not so concerned about the increased cost for their gig economy workers as of now, but I'll still be monitoring this space.
Yeah, for me, I totally echo what Thomas is saying. I think in Meituan, the way I think about it is also like the food delivery business, in a way subsidizing the super app for it to upsell all the other services, right? To give an example, you look at their first Q earnings, the food delivery business, the EBIT margins are around 5%. The in-store hotel travel business, the EBIT margins are around 42%. So that's 8 times higher, right? And that's why they also contributed a lot more of the profit. But I think the company is aware of the slowing growth of food delivery and travel. It's actually tipped down to I would say the mid double digit, I would say 20-30% kind of numbers. And they know, they won't be able to sustain such valuations. And that's why I think they've been actually pivoting towards community group buying, which along the lines of Pinduoduo, and because I think they know Pinduoduo is obviously the undisputed leader right now in community group buying, right? But I think with Meituan's platform itself, they've been investing a lot, and you can see a hit in especially the last 2 quarters of their margins because of the immense amount of capex to build it. It's extremely difficult to build, but once if you get it right, and this kind of logistics, it can actually hold on for a very, very long time. And I think community group buying itself is probably something positive for long term for the economy as well. You're trying to basically take away the whole supermarket. You're trying to bring basically the farmers basically end to end directly to the consumer, and you're trying to take out the entire the whole middleman chain, right? That's where the value capture is. So I think there are some good things around it, and I think it'll be interesting. And I think, to be honest, Meituan is probably going to start still incurring a fair bit of losses, at least for the next couple of quarters, because of this very heavy reinvestment in community group buying. But I think importantly, as an investor, this is what I like. If they're investing for the future, and if they get it right, and the early metrics are showing that the very rapid growth in the community group buying matrix, and that's pointing in the right direction. So I'll continue to watch a couple of quarters. And if they do that very well, I think it'll be quite transformational and bring that top line growth back to Meituan, and eventually profits as well.
Yeah, I think Eugene hit a very good point. Sorry. Yeah, so like community group buying, right, is one of the things that so the Chinese government has been saying a lot of things companies cannot do. But one thing that they actually encourage companies to go after is the community group buying space. Which is why you see JD, Alibaba, Meituan, and Pinduoduo really doubling down on community group buying, because this there's positive value proposition here. There's real value proposition here, because it brings down prices for consumers, not just in tier 1 and tier 2. And the government is also very conscious about having to deliver all these products to tier 3 and tier 4 cities, which has always been super difficult because of logistical needs. And community group buying, right, by implementing this, they are able to bring down costs of delivery such that it's able to make economical sense to hit tier 3 and tier 4. So for Meituan, I think so far they have been executing super well for this community group buying segment. I think they're almost neck to neck with Pinduoduo. Yeah, so this is also one area I'm very excited about when it comes to Meituan.
Yeah, I wanna add that a lot of people, they talk about the high margin business of all these different platforms like booking, or or like all these like book hotel, book travel, and all that. For all of you that don't know this company, you probably should take a look. Not a recommendation, but look at Ctrip. Right, so 携程, 同城去哪儿, or trip.com. So essentially, it's like the booking of China and booking.com of China. And a lot of these apps, super apps, even the super apps, so WeChat or even Meituan, a lot of them actually take supplies from these guys. And supplies not like things, but these guys, Trip.com guys, they actually consolidate all the travel, itineraries, from like flights to cruises to hotels to experiences and all that stuff. And they are one of the largest in China. So it's a company that I don't know why nobody talks about it, but when I was living there, I couldn't run away from this company. Okay, so 去哪儿 and 携程, 同城, they're all the same company now. So they all merged, Trip.com. Right, so something to look at. And for all of you that don't know, they are a very big supply chain of travel-related kind of products. Right, so interesting company, right? Take a look. And if you guys have any other questions specific to Chinese companies per se, please put it in the comment section. If not, I think we are more than an hour in. One of my friend has a particular question, not very China centric, but I want to hear your thoughts on this. Has anyone been following the developments with Tether? So since smart people gather, right, let's talk a little bit about Tether and the theories, heavily reliant on commercial papers from the likes of Avang, how do you pronounce that? Grande? Okay, whatever. Evergrande. Okay, yes. So yeah, essentially, I think the discussion is, what do you think of Tether? Right? Is it like reliable and all that jazz? It's not in today's discussion, but since someone asked, any thoughts?
Yeah, for me, I can add a bit on Tether. I was looking at it when I was looking at Bitcoin personally. So I think I was looking at Tether about 4 months back, and I think, to be honest, that is the single biggest risk to the cryptocurrency, and specifically around Bitcoin, in my opinion, because a lot of the people have to use cash to buy US dollar T Tether, and then use US dollar T to buy other cryptocurrencies, and sometimes a lot of it is bought into Bitcoin. The tricky bit is that a lot of the exchanges all use Tether to buy. Now, the fundamental thing is that it's not exactly back one to one as cash, right? And a lot of you look at the Tether composition, a lot of it's in notes. And I've been reading a fair bit, a lot of talking, right? If they're buying so much notes, how come nobody knows exactly that is the customer, right? So those are generally some kind of red flags. And I think the tricky bit is this, right? if the world goes for a bank run on Tether and everybody choose to withdraw their cash right away, and there's not enough Tether, it's going to massively hit the cryptocurrency market. Right, I think that is the single biggest risk. I think right now, is the music is continuing to keep going, but if everyone finds that there's no confidence in Tether and everyone keeps withdrawing it, and eventually Tether doesn't have enough dollars at the back of it, he can't keep printing enough, right? That's going to be a major problem, and then everyone starts to realize, okay, I'm stuck. I have to get out now. The whole massive selling goal happens. I think that would do cryptocurrency, I would say, a massive blow. So I think that is the single biggest risk, in my opinion.
Yeah, for sure. Anyway, guys, we have one more question. Can we take that question?
Yeah.
Yeah.
Okay, sure. Yeah, getting a bit late. So yes, Boomer wants to sleep. Anyway, so yes, what does investing in China's tech companies VIE structure mean for investors? I think this is something, worthy to discuss.
So I actually just wrote about this on my blog. So for a lot of Chinese industry, right, when it comes to tech companies or even the education industry, where they deem security to be an issue, they actually don't allow foreign investors to own shares directly. So the thing about these Chinese companies, if the shareholders, the founders, they still want to retain a big chunk of their shares, right? They will have to go to New York Stock Exchange to list, because that's the only place whereby they can get dual listing, where you look at your Class A and Class B shares, whereby you can set Class A to have a disproportionately higher amount of voting shares. And to do so, to circumvent this, what a VIE structure essentially means, when you buy a Chinese company, you don't own the company. What you own is a contract to the underlying profits, voting rights, etc. Yeah, so essentially this is what a VIE structure means. You don't own the company. What you own is a contract that allows you to have the underlying profits.
Yeah, the way I think about it is exactly what Thomas is saying, right? If you think about it, VIE is basically you own the right to the cash flows, but you don't own the ownership itself. And if you think about it, the US and Hong Kong, there is no difference in terms of the VIE structures. It's exactly the same. But of course, Hong Kong is going to be a bit more friendlier than the US, just because the US, they can anytime turn around, right? And when they have political wars, they will use the VIE as a structure. I think the read-through for VIE is still going to be a major concern, because you think about it from China, they've been trying to grow their economy and trying to expand and to allow internalization of the currency. So China has been really open. Their whole trade side current account, they've already opened. On the capital account, they've been gradually opening the bond markets, but now they're trying to open the equity markets. Right? They eventually have to move towards that. And the whole thing about the VIE is that they themselves to actually eliminate the VIE structure on their own eventually in the long term, because they want all the Chinese companies to eventually list back in China. They want foreign capital to come back into China to be investing in RMB, because when you have a lot of foreign capital investing in RMB, the RMB will be strong, and that's basically it, right? So they know long term, if you need a strong currency, everyone has to be investing in RMB, and that's what the US has actually enjoyed for a very long time. So I think the long term path is probably going to move along towards that path, but I think it's going to take years, if not decades, right? For this, right? There's no simple answer, because there's so much at stake, and also because these companies are so big, the market cap is going to be like case, right? I mean, even if you move to Hong Kong, it's still going to be a VIE. What's the real difference? So I mean, there's not much of a difference in my opinion, and hence personally, also I have not done that switch from US to Hong Kong. But I think we just need to be very cognizant. I think there's going to be a lot of news, a lot of regulations, a lot of noise around VIE. It's going to be used as a bargaining chip whenever both parties are unhappy about each other, right? So I think we just got to be very cognizant about that. And again, I think just limit the risk. That's most important. I think in investing is ultimately not being wiped out. The best investors last for decades because they're not wiped out. And I think you have to size your risk such that you're not being wiped out. I think that's extremely, extremely crucial.
Maybe I share one example on when VIE went wrong. It was back in like 2011, 2012. Again, this is with Alibaba when it was still a private company. So SoftBank and Yahoo were its major shareholders back then. And the Chinese government hinted that Alipay is too important for a foreign shareholder to own a stake in. And because so a VIE structure essentially is against foreign shareholders. So when Alibaba is invested by SoftBank and Yahoo, it went into a VIE structure. And SoftBank and Yahoo were extremely pissed when they suddenly just took Alipay. So they just spin off Alipay without consulting SoftBank and Yahoo, who were major shareholders. But because it's under this VIE structure, they just spin off Alipay just like that, and they just lose a crown jewel, because it is the leading fintech services in China. So investors just have to be aware that something like this may happen. It's not that it never happened before. Recently, the government have actually stepped in to say that they are not against the VIE structure. Because of all this regulation, there's a lot of chatter in the market, and they have come in to reassure investors we have nothing against VIE structure. It is really after the social impact. Yeah.
Yeah, but okay, so I'm a bit kiasu. If there is Hong Kong, I can buy from Hong Kong, I will buy from Hong Kong. Okay, because like what Eugene said, I want to sleep well, so I don't want this kind of spat to disturb me. So as much as possible, if there's exposure in Hong Kong, I will take it from there. But eventually, I also believe that it's stupid for China to have two currency, so Hong Kong dollar will also disappear. Everything will be under one RMB. All right, but that's a whole macro discussion of exchange rates and all that. That's a very long. Another day, okay, for another time, right? So I think we are off the north of the hour. So thank you guys for tuning in. If any one of you have any last comments, you have 3 seconds, okay, while I wrap up. So thanks for tuning in. If you guys want to continue to learn more about what Thomas Chua has to say, head over to steadycompounding.com. If you want to buy Eugene's book, head over to Vision Capital. And yeah, I will get my producer to talk to you to come on our show and talk a little bit more about your book and your investment ideologies. Okay. So for everyone else that's listening, thanks for staying with us until 10:15. I appreciate it. If you want more information, come to our Telegram group, The Financial Coconut, to hang out and chat and continue your discussion. Sign up for our weekly newsletter at thefinancialcoconut.com. Okay, so all the plugs are done. I'm good for today. Any last things you guys want to add?
No, I'm good.
No, I'm good as well.
No, we're good. We're good. Okay, again, have a good sleep. Good night, guys. Take care. Woo. Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community's Telegram group, follow us on our socials, sign up for our weekly newsletter. We are doing a weekly newsletter reboot. We're going to have a lot of information within the newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, if you have any interesting thoughts you want to share, or you know someone that we would like to hear from, reach out to us through hello@thefinancialcoconut.com. With that, have a great day ahead. Stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Okay. I also want to add that you don't need to be invested in China if it's not your thing. Everybody has their own investing style. So I want to reassure you that although we are dedicating quite a lot of time talking about China, because it is currently the hot topic, hey, you don't have to do it. Find comfort in your investing strategy. But if you have a manager, you have someone that's, doing your portfolio, always ask them what is going on, what is their thoughts, and what's their perspectives. And you can always bring these thoughts and questions and perspectives back onto our Telegram group, to connect with us and talk to us. And we can see, different perspectives and come to a better, more educated decision, right? So next week, we'll have Freddie on the show to talk about the macro stuff, the higher level, higher order things. So yeah, join us next week. I see you guys. Also, sign up for our weekly newsletter, and also sign up for our new podcast, TFC Stock Geek Out, if you're a big fan of trying to pick your own stocks, learn how to invest, or even just stay relevant to whatever is happening in the markets. So TFC Market Updates, TFC Stock Geek Outs will all be placed under TFC Stock Geek Out. So go on your favorite podcast platform and, just give us a follow, like, share, subscribe. See ya.